Hey guys, welcome back to my YouTube channel. Thanks for visiting, I really appreciate it. So today, this little video, it might be boring to some of you, so if you're not interested in it, just hit the little X button. We've got a question from Jim about one of my absolute favorite subjects to talk about. Something that I'm very interested in, and something I've been interested in since I was a kid. It's about investing. This is something that from the time I was, a little boy, my grandpa was teaching me about stocks and about business. I've just always been fascinated by it. So Jim says, "Hey Mark, I would like to ask you some questions, like we were some new acquaintances talking at the local coffee shop. I find it fascinating that you have an interest in business and that you bought your first stock at 17. What type of stock areas do you like to invest in? Have you ever had one of those great stock stories where your investment proved highly profitable?" Jim, you hit the nail right on the head. I love investing. It really is fascinating to me. Actually, before I left New York, I had a friend as a going away present. He gave me a limited edition or revised edition copy of The Intelligent Investor, which is probably the best investment book ever written. I did buy my first stock at 17, but I went about it in a way that probably wasn't so good. You can't open your own brokerage account at that young. So I borrowed my dad's name and social security number, and I created a custodial account and linked it to my bank account without him knowing. And I was kind of buying and trading stocks that way, without much success, I might add, at that point. But ever since I've had an earned income, I've been more interested in buying stocks than shoes, or investing than buying jeans and all kinds of flashy stuff. I think it's far more fun to make money than to spend money, but that just happens to be the personality I was born with. I think it's more admirable for somebody who has a spender's personality to be a saver. That takes a lot more dedication. But anyway. I was really lucky that when I was young, my grandpa taught me quite a bit about stocks. He was a really successful investor. He did far better for himself as an investor than as a worker, and that's something that inspired me. How somebody who could have a good job but nothing really great, like mid-level management, could accumulate a lot of money just by being smart with it over the course of their lives and investing. And what I realized at an early age is that a dollar earned and saved today is invaluable to you in the future if you invest it. It will grow so much over the course of your life. So whenever I think about spending money on something that's expensive, I always ask myself, not just is it worth the cost of what it is today, but is it worth giving up what that money would be worth to me in the future? So my grandpa taught me to think like that, and that's something that I'm very appreciative of. And he also kind of inspired in me a natural curiosity about business. Anytime I meet somebody in a business of any area, I'm always fascinated by it. I want to know how, what the economics of that particular business are, how it works, what makes one business in that area thrive while others fail. It's just very interesting to me. So, I bought my first stock at 17. What areas do I like to invest in? Well, I have a little checklist. First of all, I like companies that are at pretty low multiple of earnings. I think a lot of times when you're looking at companies that are selling at really high multiples of earnings, it's because people are speculating about how bright the future will be. But the truth is, I don't want to pay a fortune for the potential of future earnings. And you do miss out on some pretty cool things by having that mindset. Because when Amazon was at 50 times earnings, I still would never have bought that, and now it's selling at it's gone up quite substantially since then, and now it's like at maybe 200 times earnings, you will probably still see some appreciation in the stock. But I don't know, in terms of holding something for the long haul, that it'll pay off, because eventually when things start to trade at these huge multiples of earnings, they eventually kind of, just as they skyrocket, they come back down pretty quickly. And that was the case with so many companies during the tech bubble, the internet bubble, selling at this really crazy multiple of earnings. Companies that are worth nothing one day, and then they're worth billions of dollars the next day. That's really not something that's sustainable. So number one on my checklist is not paying a fortune for the future earnings. So a low P to E ratio. The next thing would be things that are strong, that just have name recognition. It's one thing to have, for a company to have market share. It's another thing for them to have share of mind. That's not something that, that really, really insulates a company from competition. When the public, for instance, Johnson & Johnson, even though they're having a few little issues right now, but when you hear Johnson & Johnson, parents immediately assume that's the shampoo they want to use for their babies. That's the Band-Aid they want to use for their kids. Johnson & Johnson doesn't just have market share, but they have share of mind for the public. So I think that's really a very important thing to look for, because you're actually looking to say, why is this company going to do well in the future? I don't think you should buy things because you're saying, well, this financial person told me in a year the stock price is going to jump, or this or that. You should be looking at things and say, why will this company do well over the long haul? Because if you're not picking companies that you think have a very bright long-term future, you're really just speculating. You're saying, I'm hoping this stock will jump in 6 months or in 3 months, and I just don't think that's a good way to make money in stocks in the long run. So that's my second thing on the checklist, is companies that I feel have really strong entrenched positions within their business, where the public trusts the name. Excuse me. The next thing that I look for is great companies that will periodically go on sale, which happens a lot. About two years ago, J.P. Morgan had kind of a little mini scandal where a trader had like $1 billion loss for some oversight that he had made, and the stock dropped, I don't know, like 8 or 9%. And J.P. Morgan is a relatively strong bank with great brand recognition and all of that. So when the stock dropped, I bought some of it. It's a great company that went on sale. The fundamentals were pretty good. I think I've seen like a 50% return on that investment over the past 2 years. So you'll say 25% a year, which isn't bad. Recently, two things that I've bought that are great companies that have gone on sale would be Mosaic and Potash Corporation, or as we would say in Mississippi, Potash Corporation. But those are both, if you look up the balance sheet on Mosaic, it's absolutely fabulous. That's a super strong company that will do incredibly well for the next decade. But because of slight disruption in the potash supply because of a Russian supplier, the prices of these fabulous companies plummeted. It's crazy how things like that happen. That a little shakeup in the market somewhere can cause what otherwise is a really fabulous company to drop like a rock in value, at least in terms of the value of the stock price. The intrinsic workings of the business are still just as valuable as they were before this little drop in price. So Mosaic and Potash, those are perfect examples of great companies that go on sale. and then J.P. Morgan a couple years ago. So I do look for things like that. And I also look at, really strong companies that have a lot of brand recognition when they're nearing their 52-week low. Because a lot of times it's amazing just by spending a lot of time, reading through stock quotes and all of that. You find companies that, at one point were selling for $69. Now they're selling for $60. That could be the 52-week low. Which is a great time to buy into it if it has other good characteristics as far as the business, because there's always fluctuations in the stock price, even among very good companies. So another thing that I look for is a company that is very established and very solid, and that most people may think has peaked. Companies like Walmart or Coca-Cola, and you think, well, there's not a ton of room for growth in a company like Walmart or Coca-Cola. But that's such faulty logic. When you think of Walmart and Coke not having room for growth, that's because you're thinking about it in relation to the United States. But these are companies that have amazing distribution systems. They have huge name recognition. They're very stable. They're not going anywhere. And in addition to that, and they also pay pretty good dividends. But in addition to all of that, you have this incredible room for international growth, like China, Mexico, India. There is a huge emerging middle class, sprouting up around the world. So companies that you think may not have a ton of room for growth really do. So I also look for those. Another thing that I like is companies that have a really good history of maintaining a strong dividend or even increasing the dividend and maybe doing share buybacks that are trading at, like their 52-week low. Because not only are you getting the benefit of a company that's going to pay you a great dividend, but on the upside you get the capital appreciation if you buy it at the right time. So I'm not a big believer in this idea of just because you're buying into a stock for the dividend, which is great and it's very secure and it provides you working income and all of that. But you should still look for the upside of capital appreciation, which just means buying it at the right time. Perfect example of that is AT&T. Right now it's trading at its 52-week low or pretty close to it, and it pays a great dividend. It's a 5% dividend. So you're getting 5% on your capital, and you're getting the upside of capital appreciation. So, I think that's a great way to look at it. Not to trade the possibility of capital appreciation just for dividends. You can have, in this case, you can have your cake and eat it too. The next thing on my list is reasonable speculation. For example, I just bought into American Airlines about a week and a half ago, and you're probably saying, why in the world would you take the chance on buying into a company that's in bankruptcy? Well, it's just that is a purely speculative play. But when the Justice Department decided to intervene and block the merger at the moment, the stock price basically dropped in half. So I bought it at like $2.80 a share. And I believe that the merger will be approved. I don't think that it'll even go to trial. My guess is both sides will probably settle with some concessions before it goes to trial. Even if it does go to trial, I think that it'll get approved. And the stock price is going to go up. I'm most certain of that. So I bought it at $2.86 a share, and last time I checked it, it's at $3.40. So I've already made a profit on it. But I think once the merger is approved, or they decide to settle before going to trial, it's probably going to jump up to maybe $6 a share, possibly $7. So again, I do reasonably speculate from time to time, but in general, I don't do that. Let's see, as far as individual stocks, let's see. At the moment, and I've just double-checked this, I have 38 securities. They go from the energy sector, healthcare, American and Canadian banks, chemical companies, and then well-known companies like Coke, AT&T, Walmart, IBM, Apple, and even World Wrestling Entertainment. It pays a fabulous dividend, and I think, it has absolutely no competition to speak of. And it's certainly a company that's run for the shareholders because the McMahon family owns like 80% of it. So, of course, they have what's in the best interest of the stock at heart. Anyway, so, business to me is just absolutely fascinating. And I think that it's pretty easy to, as far as investing goes, pretty easy to do well if you just use common sense and you look for basically sure things. Again, occasionally I'll speculate, but it's not very often, and the only time that I do it is if I'm really, really confident that my line of thinking is correct. But money is far too hard to come by just to put it into a stock because you guess that it's going to go up or someone told you that it's going to go up. If you're listening to other people to get your stock advice, I think you're in trouble. You have to be able to take information in from wide array of sources and process it yourself and decide, is that worth committing your capital to? Money is really, it's hard to come by. You have to work hard for it. It's not something that you want to just throw away. And a lot of people turn their investing into basically high stakes gambling. Somebody gives them the stock tip and immediately they sign on to their brokerage and they buy it, and without knowing the first thing about the company. What is the price to earnings ratio? What are the assets versus the liabilities? What's the long-term potential of the company? If you can't answer those kind of things intelligently, you really shouldn't buy the stock. But so many people do that. And I just, that's something I was really lucky that at an early age, my grandpa taught me how to research these things and look for sure things. And he, it wasn't that he was a very sophisticated investor, and neither am I. I mean, there's lots of aspects to the market that I really don't understand. But again, I think as far as evaluating individual companies on the merits of their balance sheet, on the price to earnings, and all of that, that's pretty easy to do, and you can do very well by buying good companies when they go on sale. And I can't say enough about how much my grandpa inspired me as far as, and he was also very generous. That when I was 21, I got a fair amount of AT&T stock from him that was very generous. He gave to me and my brother and my sister, and then after he passed away, we all inherited some more. And of course, I divested myself of the AT&T stock because at the time I didn't think telecommunication stocks were all that great, and I thought I could find better uses for it. But anyway, he was really such a mentor to me and such a big help. And it's a really great thing when you teach someone how to be self-reliant, and you teach somebody that you're responsible for your own financial health and your own financial well-being. It doesn't matter what you make, you can almost always save something. I shouldn't say you can always save something. I mean, some single mother with 2 or 3 kids and she's got 2 part-time jobs or a part-time job and a full-time job, I don't think she has a ton of disposable income to save. But I do think that the average person, no matter what they make, can always save something. And that was a great lesson my grandpa taught me. So I really, really appreciate you giving me the opportunity to talk about this question. This is really something that I enjoy discussing more than porn or working out or any of that. This is truly a passion of mine. So thanks for asking. I appreciate it. And I hope you guys enjoyed this rambling on about stocks, but it's such a such a passion of mine that I'm really glad somebody asked about it. And for anybody who is under 18 and watching this, don't take my advice about borrowing your parents' social security number and creating your own brokerage account. Alright guys, thanks again for visiting my YouTube channel. I really appreciate it. Talk to you all later. Bye.